Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing First Solar stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 30 billion market cap. They're trading at $2.76 a share and they have 107 million shares outstanding. I'm going to try to do 6 videos on the solar industry. If I have enough time, the second video I'm going to do this week is Enphase Energy, then Next Tracker, Sunrun, Solar Edge, Canadian Solar, and Jinko Solar. Let's get back to First Solar. They provide photovoltaic solar energy solutions in the US, France, Japan, Chile, and other countries. They manufacture and sell PV solar modules with a thin film semiconductor technology that provides a lower carbon alternative to conventional crystalline silicon PV solar modules. It designs, manufactures, and sells cadmium telluride solar modules that convert sunlight into electricity. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have negative free cash flow each year. It was a small negative in 2022. The negative got bigger in 2023. Then it went down a little bit in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. Surprisingly, that's positive in 3 of the 4 time periods. It was negative in 2022, over $1 billion in the trailing 12 months. Revenue is a sales for the company, and that goes up decently from $3 billion to $3.6 billion. It did fall 10% from 21 to 22, but it did rebound in 23, up 7% into the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $51 billion. We discounted the numbers back to today using a weighted average cost of capital. We get a value of the company of $40 billion. We divide that by 107 million shares. And we get a calculated stock price of $3.76. They're trading at $2.76, so they're trading at a 27% discount. It's a strong buy according to the model. Their free cash flow is forecasted to grow a lot over the next few years. If that happens, the stock will definitely go up a lot. There are 26 companies in the same industry as First Solar, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, that's the investments in property, plant, and equipment. They don't have much debt, a really low debt to equity ratio of 0.1. It looks like only one company in this industry pays a dividend. First Solar does not. They still have negative free cash flow like most of the companies on this list. They're the largest company in this industry, a good amount ahead of Enphase. Their price multiples don't look so great, trading at 4 times book value, 29 times earnings, and 8 times sales. The reason their price multiples are so high is because investors think the company will grow a lot in the future. They generate a lot of revenue, $3.6 billion. That's third on this list. Their revenue isn't growing that much, only 10%, much lower than Enphase. If you put $10,000 into this company 10 years ago, after about 6.5 years, you would have been down. But then the stock really took off, and your $10,000 would have been $42,000, a 15% annual return. Let's take a look at their first quarter 10Q. We'll start with their income statement. Look how much their revenue went up from $548 million to $794 million. That's a pretty big jump from 1Q23 to 1Q24. Let's see if they give a breakdown of the revenue. Almost all their sales are in modules. They talk about it right here. Our main segment is our modules business. That's designing, manufacturing, and selling cadmium telluride solar modules, which convert sunlight into electricity. Their customers include system developers, independent power producers, utilities, commercial and industrial companies, and other system owners and operators. Their residual business includes certain project development activities, O&M services. After a company like this installs solar, then either this company or another company has to handle all the servicing and operations. O&M stands for operations and maintenance. Because sometimes the panels don't operate well. I had that problem. Especially after big blackout in my neighborhood, the panels weren't working right. So it appears they do O&M services. Other went down a lot, from 12 million to 700,000. And they're losing money in that segment. They actually made a good amount of money percent-wise, about 45% margin. Much better in modules. Modules is only 20%. But look how high the margins I've gotten in modules. It's probably up to 40%. When I say margin, I mean gross profit margin, which is gross profit over revenue. It's the percent of their revenue they convert to gross profit. Let's get back to the income statement. Below revenue is cost of revenue. These are all the expenses directly tied to generating the revenue. That's 448 million. Revenue minus cost of revenue gives you a gross profit. Look how much their gross profit went up. It more than tripled, and their revenue didn't even double. So they're doing a great job at managing expenses. Actually, their cost of revenue is almost identical to last year with much higher revenue. They do have operating expenses, SG&A 46 million, selling, general, and administrative expenses. They define SG&A right here. It's salaries, professional fees, insurance, and other business development and selling expenses. As a percent of revenue, it went down a lot. It was 8% in the first quarter of 2023. Now it's 5.8%. They really lowered their expenses. Research and development went up from 31 million to 43 million. But it went down a little bit as a percent of revenue, from 5.6% to 5.4%. R&D consists of salaries, the cost of products, materials, and outside services used in R&D activities. It also includes depreciation and amortization associated with R&D specific facilities and equipment. They maintain a number of programs to improve technology and processes in order to enhance the performance and reduce the costs of their modules. Let's go back to the income statement. Below R&D is production startup, 15 million. I wonder what that is. This is the expense for operating a production line before commercial production. So it's more testing before the product can be rolled out to the masses. This includes the cost of raw materials, employee compensation, and applicable facility-related costs. This also includes the cost for the selection of a new site, also manufacturing process improvements, unless of course they can capitalize these expenses. Capitalize means putting the expense on the balance sheet, then depreciating that expense over a number of years onto the income statement. Their total expenses are 104 million, up from 94 million. Operating income 240 million, up from 18 million. That's a drastic improvement. And their net income is 237 million, up from 43 million. The big swing is income taxes, a $26 million swing. Last year, they had a tax benefit of $7 million. This year, they paid $19 million of taxes. So their EPS is 40 cents. It went up 5x to 221. And their shares outstanding are pretty much the same, about 107 million in both time frames. Let's take a look at the balance sheet. 4.2 billion of current assets, 1.8 billion of current liabilities. So they're a really high current ratio. Current ratio is current assets over current liabilities. It's about a 2.5. They have a lot of cash, 1.7 billion, plus 300 million of marketable securities. So it's like they have 2 billion of cash. 670 million of accounts receivables. So this is money they will receive in the future. The great thing about the solar industry is you get funding. Government grants, 185 million. They have a lot of inventory, almost 1 billion. Here's a breakdown of the inventory. 450 million of raw materials, 91 million work in process, and finished goods 700 million. So that's 1.2 billion. 1 billion is current inventory. Inventory they're going to sell within the next 12 months. Then you have 265 million non-current. Inventory they're going to use beyond 12 months. Here's the 265 million. It's in the non-current asset section of the balance sheet. PP&E is their biggest asset, 5 billion. Here's a breakdown of the 5 billion. 1 billion buildings and improvements, 3.7 billion of machinery, and 1.7 billion of construction in progress. So that's 6.7 billion. They depreciated 1.8 billion. So the carrying value, the book value, is 5 billion. So total assets 11 billion, up from 10.4 billion. Total liabilities 3.9 billion, up from 3.7 billion. Their biggest liability is the best liability, deferred revenue. This means they receive payment, they receive cash for a product or service they haven't delivered yet. This is a common expense for like a magazine company. Say you pay for a year up front for a subscription to magazines. You pay $120 for the year. It's $10 a month. So the company, the magazine company, cannot book all the revenue when you pay them. They have to carry it in the balance sheet as deferred revenue. Then each month they take $10 off of deferred revenue and book it as revenue. Then after 12 months, they would have booked the entire $120. But if you multiply that by 1 million customers, it really adds up. Assets minus liabilities equals equity, $7 billion of equity. They raised $3 billion from selling their business. They profited $4.2 billion from running their business. Let's look at a statement of cash flows. They actually have positive operating cash flow. Last year was negative. So that looks really good, positive $270 million. The way you calculate operating cash flow, you start with your net income, then you add back the non-cash items on the income statement. Depreciation is a big one, $91 million. You also need to minus the non-cash items on the income statement. Deferred income taxes. These are taxes a company will eventually pay but are not due yet. The main reason deferred income taxes appears is because of the way the IRS depreciates an asset and the way GAAP does. It's a little different. So you have to carry the taxes on your balance sheet, but in the end, it all equals out. They spent a lot in inventory, $150 million, and here's that deferred revenue. They had a cash inflow of $38 million. Last year, they had a cash inflow of $140 million. They also spent a lot on accounts payable. This means they bought on credit in the past, but they had to pay it back this quarter. They paid back $161 million. And the reason they have negative free cash flow is because they spend so much in PP&E. Free cash flow is operating cash flow minus CapEx. So $267 million minus $413 million. But if a company has negative free cash flow because they're spending a lot on CapEx, that's a good thing. If a company has negative free cash flow because they had negative operating cash flow, that's a bad thing. Let's look in the financing section. They added $100 million of debt. They repaid $46 million of debt. And they paid $19 million in taxes on employee stock. Let's take a look at a company on Simply Wall Street. Its last price, $267, $29 billion market cap, down 1.5% in the past week, up 39% in the past year. Here's their stock price since they started trading in 2007. It looks like it IPO'd in the high 20s. That was in December 2006. Fast forward 1.5 years and the stock almost hit $300, the highest ever. If you bought it up there, you would have seen the stock come down to its lowest point ever, a little over $12. That was in mid-2012. It did go up over the next decade, but there was a lot of downs along the way. So after 10 years, you're at 67. But you could see it's really blown up the past few weeks. It went from 200 up to 280. It's regressed a little bit, people taking in their profits to 270. Simply Wall Street is right with me. They're at $365 a share. 29 analysts priced this stock at $259. They have a really bullish revenue forecast. This year, $4.5 billion. Next year, $5.6 billion. Then $6.7 billion. And their free cash flow forecast for this year is negative $400 million. Next year, positive $1.3 billion. Then $2.2 billion. This is not what you want to see. Their revenue didn't go up since 2013. It was $3.2 billion, and now it's $3.6 billion, so it barely went up. It did peak in 2015 and 16, over $4 billion. Then it fell below $2 billion in 2018, so really volatile revenue numbers. This red line at the bottom is their debt. The blue line is their equity, so they always have a good debt to equity ratio. In 2013, it was $4 billion of equity, 1/4 of $1 billion of debt. Still below $1 billion of debt, almost $7 billion of equity. And this green line is their cash. You can see they always have a lot more cash than debt. Currently $2 billion of cash. The salary for the CEO, $750K. It's almost at $1 million. Total compensation, $7.7 million. His tenure as CEO, 8 years. Their employee count is up and down like their revenue, 5K in 2013, up to 6K, down to 4K, up to almost 7K, down to 5K. Now they're almost at 7K again. In the past year, a lot of insider selling, only one buy. 91% of the companies owned by institutions, 6% by insiders, and 4% by the general public. Their biggest shareholder is Vanguard at 11%, BlackRock at 11%, and then you see companies like Wellington. Invesco owns 2%, Amundi, the French asset manager, UBS, Susquehanna, and the ticker trades on the Nasdaq, Deutsche Börse, Xetra, Mexican Bolsa, Swiss, London Stock Exchange, Wiener Börse, Euro TLX, Buenos Aires, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.